In July 2025, the world economy showed mixed momentum. The United States remained resilient in services and consumer spending, but global growth is slowing. The IMF now expects worldwide GDP to expand by just 3.0 to 3.3% this year, as tariffs, inflation, and monetary policy divergence weigh on confidence. United States. America's trade deficit narrowed in July. Imports fell sharply as businesses front-loaded shipments ahead of tariffs. New U.S. trade rules now include a 10% baseline tariff on most trading partners. Tariffs on Chinese goods were reduced from 145% to 30% by May, easing some inflationary pressure. The Federal Reserve held interest rates steady at 4.25% to 4.50%, though rate cuts are likely in September and December as the labor market cools. Investment strategy? Overweight U.S. large-cap stocks with strong cash flow. Build a barbell in fixed income, short-term T-bills, and long-term treasuries. Keep 5 to 10% cash ready for opportunities. The Eurozone grew by just 1%, helped by easing inflation and rising wages, but hurt by weak exports and U.S. trade friction. Investment strategy. Neutral on equities. Emphasize defensive sectors like healthcare and consumer staples. Favor high-grade euro-denominated corporate bonds. Expect the euro to move sideways unless trade risks escalate. China's economy outperformed, with 5.2% GDP growth in the second quarter. Exports to Asia surged 12%, softening the blow from a 24% collapse in U.S. shipments due to tariffs. Investment strategy. Selectively overweight domestic A shares, especially in consumer sectors. Hold high-quality government and policy bank bonds. Hedge any yuan exposure. Volatility is expected to rise. The UK's housing market is recovering, but overall growth remains weak, just 0.8% expected for 2025. Inflation could peak at 3.6% by autumn. Investment strategy. Prefer multinational FTSE 100 companies with strong foreign revenues. Buy short-term, high-grade sterling bonds and medium-duration gilts. Portfolio positioning. In today's uncertain environment, build a balanced portfolio. 55% equities focused on quality. 30% bonds, diversified by region and duration. 10% real assets like gold and commodities. 5% cash, held tactically. Closing. With rising risks from tariffs and policy shifts, market timing is not your edge. Selective asset allocation is.